What is going on, everyone? It's Ed Zoller, Villa Realty Group, with your April market update. I finished on May 1st after I compiled the data, finished the graphs. This is a highlight video, which is only going to go over the graphs itself. But if you want to read through the entire thing, about a 30-minute read, if you go through each slide, I'll have that available. But this video is kind of like the highlight video that I'm going to go rapidly through the graphs and the changes and things to highlight. And I have a handy dandy laser pointer now that you can look at. So inventory growth, we went up in April. We don't go up in April. As you can see, March, April, down. March, April, down. March, April, down. Well, this was COVID. Nothing. We just went down, 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 down. We never went up. We lost all of our inventory when there was no homes that are available for people to buy. And then ever since April 2022, and I would really say 2023 June was where we thought, but look at this increase of inventory and this rapid increase of inventory. We had 1,800 homes, and now we have 10,000 homes. That's a huge increase. And right now, just year over year, from last year to this year, Lee County ranks number third fastest in the country. And Punta Gorda, Port Charlotte are number one in our state, second fastest in the country. But just something to pinpoint here, that inventory normally goes down in April, and it's going up. And so this is something I have not seen in 8 years. As far as inventory growth year over year, you can see that Florida far exceeds Vermont, Alabama, Mississippi, and all the other top ones out there. And I rank the top 50 states as far as inventory growth. So we are seeing a huge escalation of inventory growth in our state. And there might be a reason for that, which I'm going to highlight a little bit later, but we'll move on to the next one. Demand. Demand went down. Well, demand always goes down in April. Down, 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 and then continues to, as you see here, continues to go down. This continues to overall go down, and then doesn't really start picking back up again until, guess when? January. And that's always been our season. January to April is our time, January to March being the peak time of demand. But I do want to look at the trend here from 2021, 2022, 2023, and now 2024. We didn't even hit our long-term average of 1,900 sales in a month. And right now we are going down, and this only historically would say that this is going to continue to go down. And I think the reason we're not hitting the average of what we had long term is also going to be talked about a little later when I talk about where the buyers have all gone. Our home prices, again, has gone down. It went down 1%. That's for the average home, about $4,000 drop in value. And you got to think about the sellers out there. Are they getting this memo? Do they understand that if they're asking $400,000 for their home and they price drop to $390, but the house is really worth $385, and it goes down $4,000 or $5,000 a month or even more as it did back here, uh, will they be able to catch up? Well, if they drop $4,000 and the market drops $4,000, they didn't change their position at all. So you're going to see quite a few price drops, more than normal, and you're gonna probably see substantial price dropping, because right now I'm gonna tell my sellers, if we went down $4,000 as a market, you need to go down $8,000 to stay ahead of this curve to get out of this. Now, something to highlight in this graph, this is the long-term average. And you can see here that we kind of stabilized in 2016. What happened in 2016? Well, interest rates were at about 4%, December 2016. And then the market started increasing as our interest rates stayed the same. It wasn't until 2018 that the Feds tried to spike that rate to 5%. It failed. It kind of leveled off, and then it started escalating again. And come 2019 here, interest rates were 3%, and it went all the way to 2022 at 3% until the Feds started increasing their interest rates rapidly from a 3% to a 7%. And look what happened to the prices. That's not normal. This blue here is, I call this your fake equity sellers, that your market should really be about here. And this is how much fake equity was gained because of the craze that the pandemic created on our market and many other markets all across the country. But yep, so the big thing out of this is average home price dropped 1%. Everyone lost $4,000. And why did it drop? And why is demand so bad? Well, the first indicator I like to look at here is the affordability. We're just not affordable. This is what's affordable here. And let's go back to those interest rates I talked about. Affordability kind of spiked right here because interest rates were at 4.5%. In 2018-19, they spiked to 5 in affordability because prices kept going up like that little engine that could. As interest rates went up, the affordability got worse and worse. And then the Feds cut the rate in 2019 to 3%, Fed rate down almost to zero, and we became very affordable even as our prices were going up. But then when they decided to increase in 2022, we became unaffordable right at that moment, and then prices continued to soar. We are right now 42%. The last time we saw 42% was right here in the 2006 2007 bubble. That then popped as prices plummeted 9 to 10 grand, 2-3% drops in price until it stabilized again and got back to the what I say this line is the normal. We are higher, and one reason is because interest rates on their own went up in the month of April, up an eighth to a quarter of percent. Although our prices came down and our average household income went up, affordability got worse. We are less affordable than we were last month, and so that's something to consider. And then the home value growth itself, this is what we drop on a month-to-month basis. And as you can see here, we've hit a high of like 2.6. Right here it was 2.6 increase. Of course, when we were dropping at our worst crash in 2008, we were negative 2.6 a month, not a year. And you can see here that we are right now at 0.21. But the thing to track here is consecutive months. As soon as it plummets under this zero, that is a consecutive month of negative growth. This was 59 consecutive months until it started stabilizing itself. This is the sign of a stabilization, and being under this graph for a long period of time is not good for prices. But right now we are at 9 consecutive months of negative growth in our market, showing that prices are going to continue to go down. So overall stats. We went from 10,000 to 10,189, up. We did have that little spike in demand last month, and I assume that homes for sale would have gone down, but they did not. They went up. Our solds went down. Our pending sales, houses that just went under contract but haven't closed, they went down, showing the trend that buyers are starting to fall apart. But the big thing to me is last month I talked all about the builders, their incentives, their crazy $80, $90, $100,000 incentives, and after all of that campaign that they did, they CO'd or closed on less homes than they actually put on the ground available for sale. You can see here it increased another 60 homes just from new construction alone. So builders are going to continue these incentives, and ultimately they need to drop their prices. Instead of offering 80,000 worth of incentives, they just need to drop their price half that and still offer those incentives to move their market. So this indicates here new construction is probably the way of the future for any buyers out there. Of course, is the builder going to still be in business? Can they afford this stuff? Very few can. But average time on market stayed the same. Median asking price went down back to a kind of a normal level, and our selling price went down as well. But something to indicate here that the percent of asking price to sold stayed the same, and it's been the same for the last 2-3 months. And why is that? Because people were asking 400,000. They have to price cut down to 380 to sell it for 370, 360, or something like that. It's an interesting if I took all the solds and saw what their original asking price was. I think this is a normal 6% of asking price is a kind of a norm, but we're seeing massive price cuts in our industry, and that's the next graph to go over with you here. Look at the escalation of price cuts. And this is the long-term norm, 22% of houses, and this is throughout our state, but 22% of any home on the market will price cut itself, 1 out of 5. Right now we are at almost 38%, and this big spike here I think is only going to get worse. As more and more inventory hits the market, they're going to have to compete. That causes the next seller to compete and the next seller to compete, and price drop after price drop. And this is why you're going to see houses drop in price. I think it's going to escalate and go even further. Well, of course, we'll have to see. But when you have 37%, just compare this. March 2017, remember in 17, they raised the interest rates up. The sellers had to offset that interest rate increase by doing this and doing right here. And then they didn't have to price cut as long as interest rates were at 3%, and you saw that very few of them did. And then in COVID, no one did. They didn't have to. The houses sold themselves. But now we are back up to kind of a record high. Although in 2006 to 2010, we were higher than that. Of course, we were also in a full-blown crash. And then analyzing state of Florida, look at where Cape Coral, Fort Myers ranks. 37% is not the worst in the state. Obviously, Northport, Punta Gorda are, but look at also Tampa and Naples and the villages, and villages losing home value. There's not as many people in the villages as there say in Lee County or in Charlotte County. But something, it's not just here, it's kind of everywhere, especially throughout Florida. Obviously, are we in a buyer's or seller's market? If you're above this line, buyers need to be kind of looking and waiting for that right opportunity. It's a house of falling daggers, I call it. And so don't reach for the daggers. Let them gracefully fall into your hand. If you know your price, you kind of stick to your guns. And as long as we're above this red line, buyers have more negotiating power with sellers. They have more cards in their stacked in their favor. So if we need to ask for buy downs, closing costs, all these good things, sellers are kind of dropping their pants because there's too much competition and the sales aren't there for them to do. And so now the big news I want to discuss with you guys on why I think buyers are struggling and why sellers are also struggling because of the lack of buyers. And there was an article that came out April 15th, and I did read it. It was Bloomberg came out with it, and the Federal Reserve Bank of Philadelphia is talking about credit card defaults. Now, why credit card defaults with homes? Uh, how does that relate? Well, it does relate because when you see people not being able to afford, or you see huge spikes of credit card delinquency rates and charge-offs and credit going down, this is not a good indicator that we're going to have a growth of demand when people are not even affording their credit card bills. And why are they running up those credit card bills? Well, we're kind of we have inflation problems. We have normal cost of living, which is telling me that these walls that are being built of pressure, of affordability and everything else, that buyers are not doing well with this thing. And so delinquencies is one thing when you're 30, 60, 90 days late. And feel free to read the article. I'm not going to go over everything, just kind of highlight this graph here. The Federal Reserve has their economic data, and they have a graph going all the way to 1980s. And right now, our current charge off of commercials is at 4.2%. But what I want to show in this graph is look at the rapid increase of these charge offs. A charge off is not a delinquency. A charge off is when the bank determines it uncollectible, it goes to collections, and they give up on you. This is not a good sign. And when you see this skyrocketing thing happen, the last time we had this wasn't skyrocket, this little increase here, and it kind of leveled off, then it went back down again. And this is when the stimulus checks were all going out and people maybe didn't have to pay on their credit cards. But this is the last time that skyrocketed. We also had a big skyrocket in the 2002 eras, way up to here. And then we also had skyrockets here and in the mid 90s. And all of this kind of indicates towards, if I showed you a graph of the stock market or Wall Street or the economic conditions, these were also times where people weren't affording their credit cards. The economy wasn't doing well, and we're in a recession or depression. So this just indicates to me that people, the price of goods and services far exceed the increase in wages and income, and therefore credit cards are getting hit. And so I delve a little deeper when I read that article. I looked up Fred's economic graph there, and that kind of all made sense here. But I wanted to rank the states. What states are struggling the most? And Forbes had a fantastic article that actually ranked all 50 states and the District of Columbia about who's struggling the most. And look who is number one: Florida, ranking number one. 13.2% change in credit card debt, people having more debt, 11.68% increase of delinquencies in the fourth quarter. And Sunshine State that we have, along with Louisiana, Texas, Nevada, Georgia, pretty much all the sunny states out there, are in the top 5 that they are not affording it. And they color coded it with these dark colors here. So you see Texas, Louisiana, California, Nevada, even New York, Florida, Georgia, South Carolina. And what I did was, then I looked to see, how does this impact real estate? Very easy. When you can't afford your credit card bills, what's the next thing you can't afford? probably your car or maybe your rent. And if rent, you get evicted and eviction rate goes up, which I'll probably track next month, if eviction rate goes up, then landlords can't cash flow that property, and that kind of force places them to sell it. All those Wall Street investors who are buying hundreds, if not thousands, of homes in our area, what are they going to do? They'll dump that, and there'll be more competition. This will increase inventory. And I did see the correlation when I looked at the states with the highest spike of inventory, being Florida, Texas, California, New York, and Georgia. Well, look at how dark this is. Florida, Georgia, Texas, California, New York, all dark, dark blue. They're struggling with credit cards, and that causes people to put their home on the market, or investors to put their home on the market, and that causes inventory spikes to happen in a economy where our demand and buyers are struggling, lowering their credit scores, hiring their debt of those credit cards. And this, to me, was a shocking thing. Please feel free to read the article to dive in deeper. Love your comments or insight on this as well. But I think this is a direct correlation to our buyers going to be coming here. So overall, our inventory went up, demand went up. I just think this next stage of our market, which is going to be in the summer, we're just going to see increasing inventory. I want to see that number go down next month to show any kind of signs of stability. And that's what I'm looking for. Any of these data points, are we seeing any signs of stability? We're still as unaffordable as possible, as we've ever been. The prices are going to continue to go down. Demand is going to go down as long as they're not paying their credit cards. They're probably not going to be interested in buying a home. And to see if we can offset that fake equity, I think will rapidly start disappearing over the course of 2024. And from the last Jerome Powell quote, probably not going to have interest rate decreases, although the interest rate's doing its own thing right now by going down, going up month over month, which is making it less and less affordable, causing more prices to get pressured for those prices to come back down. My sources of data. And of course, I would love your feedback. You can see all of these on my market update website, leecountymarketupdate.com, right here. Teachers can buy homes. For any buyers, I think buyers should be, we're in a market of falling daggers. Do not reach for those daggers. You'll get cut. Just let the dagger fall gracefully. I think patience for the last year and a half has been your ally, and to continue to be patient. But buyers should still get ready and be prepared so if they want to buy a home, then be patient with that. I think you're going to see great deals in the summer and fall as more and more of this data keeps going into its trend, and we're going to have less and less buyers and more inventory. Sellers are going to get more panic, and you're going to start seeing much better deals out there month by month, if not week by week. And of course, you can always subscribe to my channels. And if you guys have any questions, thank you so much. Talk to you later.